The market is caught between two massive forces. You've got a supportive Fed on one side, but escalating US-China tensions creating major risk on the other. Let's break down which force has the edge and how to position for it.
So let's be really clear about these two opposing forces. On the one hand, you have the Fed basically telling us they're done with quantitative tightening. That's a huge tailwind. They're easing off the brakes. But at the exact same time, we're seeing supply chains being used as weapons, with China flexing its muscle over critical resources. These two narratives are pulling the market in opposite directions, and it's driving all the action right now.
And that leads us to the one question that really matters for every trader out there. Which force is going to win? Are the fundamentals with the Fed's backing strong enough to just absorb this trade war drama, or are these geopolitical tensions finally going to be the thing that cracks the market's foundation? That's the puzzle we have to solve.
To get an answer, we've got to cut through the day-to-day noise. So let's focus on the key data points, the real signals that are actually moving the market.
You can see this tug-of-war playing out in the headlines every single day. 1 minute, Fed Chair Powell gives the market a green light, hinting at easier policy. The very next, China retaliates by putting restrictions on rare earth exports. And that's a critical piece for our entire tech and defense industry. Then the US threatens more tariffs, just pouring fuel on the fire. And through it all, you get these strong earnings from banks like JP Morgan and Wells Fargo that kind of suggest, hey, the economy itself is actually doing okay. It's a very fragile floor, but it's there.
And the result of all this back and forth? Well, look no further than the VIX. The market's fear gauge just exploded, jumping over 30% in a single week to that 22-23 range. Now that's not full-on panic mode, but it is a serious warning shot. It tells you traders are scrambling to buy protection, and the price of that insurance is going up fast.
Looking at the calendar, there are three major catalysts on my radar. First, TSM's earnings. That's going to be a huge tell for the health of the entire semiconductor space. Second, we're watching the big systematic CTA funds. These are the trend followers, and right now they are positioned to be net sellers. They could absolutely pour gasoline on any move down. And finally, everyone is watching the APEC conference. Any sign of a real meeting, a real de-escalation between the US and China could turn this whole thing around in an instant.
Okay, so that's the macro picture. Now let's drill down into the specifics. It's time to map out the battlefield, the key sectors, and the key levels where this fight is actually happening.
You can really think of the market as these three different battlegrounds right now. First, you've got your direct geopolitical plays, like MP Materials or Lithium Americas. These companies actually benefit from the push to secure our own supply chains. Then you have the AI titans, NVIDIA, Broadcom. They're riding this incredible secular growth wave, but they are also incredibly vulnerable to trade issues. And finally, you have the bedrock, the banks, the industrials, the JP Morgans of the world, whose strong earnings are providing that fundamental safety net.
And this all brings us to probably the single most important number in the market right now, 6,600 on the S&P 500 futures, or ES. This level is what we call a massive put wall. There's a huge concentration of options there. If the market breaks below 6,600 and stays there, the dealers who sold all those puts will be forced to sell futures short to hedge themselves. That's what could trigger a cascade of selling from those big CTA funds we talked about. This is the line in the sand, period.
Now, before we get into specific scenarios, our mandatory disclaimer, this content is for educational purposes only. It's aggregated analysis from multiple public sources to help you stay informed and improve your own decision-making. Do your own research. This is not financial advice.
Okay, with that out of the way, let's turn all this analysis into a concrete set of if-then scenarios. The whole point here is to be prepared, to have a plan, so we're not just reacting to whatever the market throws at us.
I see three paths from here. The bull case is simple. The trade war cools off, the market remembers the Fed is friendly, and earnings are solid, and we hold above that 6,600 level. The base case, which is probably the most likely for now, is that we're just stuck. We stay in this range, chopping around 6,600, as good news fights bad news every day. And then there's the bear case. The trade war gets worse, we get a clean break below 6,600, and that triggers the automated selling, a negative gamma event where selling just forces more selling.
So really it boils down to two competing arguments. The bull thesis says this AI investment cycle is a multi-trillion-dollar tailwind that's just too big to fail. All this geopolitical stuff is just noise, and any dips are a chance to buy strategic, government-backed assets. The bear thesis, on the other hand, says that weaponizing supply chains is a true systemic risk you can't just ignore. They argue that a technical break of 6,600 will unleash a wave of systematic selling that fundamentals simply can't stop, at least not in the short term.
All right, let's get practical. Let's talk about how we could potentially structure a few trades around this analysis, with a strict focus on defining our risk from the outset.
First is a direct play on that geopolitical theme. This is a bet on the onshoring of critical minerals, using a company like MP Materials as the vehicle. The thinking here is pretty simple. As China restricts its exports, the value of the only major rare earth producer in the US goes up. We can use a call-debit spread, which is just a defined risk way to bet on a stock rising. Going out 1 to 3 months gives the catalyst time to play out. What kills this trade? Well, if trade tensions suddenly disappear or the stock breaks down technically. For sizing, this is a starter position. You can always add to it if the thesis starts working.
Now for the other side of the coin. Setup number 2 is purely defensive. It's a hedge built specifically around that critical 6,600 level on the S&P 500.
So this thesis only gets activated if the S&P futures fail to hold 6,600. The structure is a put-debit spread with a short expiry, maybe 1 to 2 weeks out. It's designed to profit from a sharp, fast move down and the explosion in volatility that would likely come with it. The invalidation is simple. If the market strongly reclaims that 6,600 level, the hedge comes off. This isn't a core position. It's a tactical hedge, sized as a small percentage of your portfolio.
And as we wrap up, our final critical reminder, this is not trading advice, just a market update to keep you informed. Markets carry risk. Trade your plan, manage downside, and verify all data.
So I'll just leave you with this one question to think about. Is that multi-trillion-dollar AI investment wave a powerful enough force to plow right through the headwinds of a full-blown trade war? I think how you answer that is going to define your performance for the rest of the year.